Welcome to our journey into the world of financial markets and institutions. Finance is the backbone of any economy, connecting people, businesses, and governments through the flow of money. In this video, we'll break down the essentials of how financial markets operate and the crucial role institutions play in keeping everything running smoothly. Whether you're a student, professional, or just curious, understanding these concepts can help you make better decisions in your personal and professional life. Let's start by exploring what financial markets are and why they matter. Financial markets are platforms where buyers and sellers trade financial assets like stocks, bonds, currencies, and derivatives. These markets provide a space for individuals and organizations to raise capital, invest, and manage risks. Think of them as bustling marketplaces, but instead of fruits and vegetables, the goods are financial products. The efficiency and transparency of these markets are vital for economic growth, as they help allocate resources to their most productive uses. Next, let's look at the different types of financial markets you might encounter. There are several types of financial markets, each serving a unique purpose. The primary market is where new securities are issued for the first time, while the secondary market allows investors to buy and sell existing securities. Other markets include the money market for short-term funds, the capital market for long-term investments, and the derivatives market for contracts based on asset values. Understanding these categories helps you see how money moves and grows in the economy. Now let's dive deeper into the primary and secondary markets. Primary market is where companies and governments issue new securities to raise funds directly from investors. For example, when a company goes public through an initial public offering, IPO, it sells shares for the first time in the primary market. The money raised here is used for expansion, research, or other business needs. This market is essential for economic development, as it helps organizations access the capital they need to grow. Next, let's see what happens to these securities after they're issued. Securities are issued in the primary market, they move to the secondary market. Here, investors buy and sell existing securities among themselves. Stock exchanges like the New York Stock Exchange or NASDAQ are classic examples of secondary markets. These markets provide liquidity, allowing investors to easily convert their investments into cash. The prices of securities in the secondary market are determined by supply and demand, reflecting the market's view of a company's value. Now let's explore the money market and its role in short-term finance. Money market deals with short-term borrowing and lending, typically for periods of less than 1 year. It's where governments, banks, and corporations manage their short-term funding needs. Common instruments include treasury bills, commercial paper, and certificates of deposit. The money market is crucial for maintaining liquidity in the financial system and ensuring that organizations can meet their immediate cash requirements. Next, we'll look at the capital market, which focuses on long-term investments. Capital market is where long-term securities like stocks and bonds are bought and sold. It provides a platform for companies and governments to raise funds for projects that require substantial investment over several years. Investors in the capital market are typically looking for higher returns in exchange for taking on more risk. This market plays a vital role in economic growth by channeling savings into productive investment. Now let's discuss the derivatives market and how it helps manage financial risks. Derivatives are financial contracts whose value is derived from an underlying asset, such as stocks, bonds, commodities, or currency. Common types include futures, options, and swaps. These instruments are used to hedge against risks or to speculate on price movements. While derivatives can be complex, they are essential tools for managing uncertainty in financial markets. Next, let's shift our focus to the institutions that make these markets function smoothly. Financial institutions are organizations that facilitate the flow of money within the economy. They include banks, insurance companies, investment firms, and credit unions. These institutions provide essential services like accepting deposits, granting loans, managing investments, and offering insurance. By connecting savers and borrowers, financial institutions help allocate resources efficiently and support economic stability. Now let's take a closer look at the different types of financial institutions. Commercial banks are the most familiar type of financial institution. They accept deposits from individuals and businesses, provide checking and savings accounts, and offer loans for various purposes. Banks also facilitate payments and help manage financial transactions. By lending money, banks support business growth and consumer spending, which are key drivers of economic activity. Next, let's explore investment banks and their unique role in the financial system. Investment banks specialize in helping companies raise capital by underwriting and issuing securities. They also advise on mergers, acquisitions, and other major financial transactions. Unlike commercial banks, investment banks do not take deposits from the public. Instead, they focus on complex financial services for corporations, governments, and institutional investors. Their expertise is crucial for large-scale projects and strategic business decisions. Now let's look at insurance companies and their role in managing risk. Insurance companies help individuals and businesses manage risk by providing coverage against unexpected events. In exchange for premiums, they offer financial protection for things like health, property, and life. Insurance companies invest the premiums they collect, contributing to the overall flow of funds in the financial system. Their role is vital in promoting financial security and stability. Next, let's discuss mutual funds and how they make investing accessible to everyone. Mutual funds pool money from many investors to buy a diversified portfolio of stocks, bonds, or other securities. This allows individual investors to access professional management and diversification, even with small amounts of money. Mutual funds are managed by investment professionals who make decisions on behalf of the investors. They play a significant role in channeling savings into productive investment. Now let's explore pension funds and their importance for retirement planning. Pension funds collect and invest money to provide retirement income for employees. These funds are typically managed by large institutions and invest in a variety of assets to ensure long-term growth and stability. Pension funds are essential for supporting the financial well-being of retirees and play a major role in the financial markets due to their large investment portfolios. Next, let's look at credit unions and how they differ from traditional banks. Credit unions are member-owned financial cooperatives that provide many of the same services as banks, such as savings accounts and loans. However, they operate on a not-for-profit basis, returning profits to their members in the form of lower fees and better interest rates. Credit unions focus on serving their communities and promoting financial inclusion. Now, let's discuss the role of central banks in the financial system. Central banks, like the Federal Reserve in the United States, oversee the monetary system and implement policies to maintain economic stability. They control the money supply, set interest rates, and act as a lender of last resort to other banks. Central banks also regulate and supervise financial institutions to ensure the safety and soundness of the financial system. Their actions have a profound impact on the economy. Next, let's explore how financial markets and institutions interact. Financial markets and institutions are deeply interconnected. Markets provide the platform for trading financial assets, while institutions facilitate these transactions and manage risks. For example, banks participate in both lending and investing, while insurance companies and pension funds invest in various markets. This interaction ensures the efficient allocation of resources and supports economic growth. Now, let's discuss the importance of regulation in maintaining trust and stability. Regulation is essential for maintaining trust and stability in the financial system. Governments and regulatory bodies set rules to protect investors, ensure fair practices, and prevent fraud. Regulations also help manage systemic risks that could threaten the entire economy. Examples include capital requirements for banks and disclosure rules for public companies. Effective regulation creates a safe environment for market participants. Next, let's look at the impact of technology on financial markets and institutions. Technology has revolutionized financial markets and institutions. Online trading platforms, mobile banking, and digital currencies have made finance more accessible and efficient. Automation and artificial intelligence are transforming how investments are managed and risks are assessed. While technology brings many benefits, it also introduces new challenges such as cybersecurity risks. Next, let's discuss the globalization of financial markets. Financial markets are increasingly global, with capital flowing across borders at unprecedented speeds. International markets allow investors to diversify their portfolios and companies to access funding from around the world. However, globalization also means that financial shocks can spread quickly from one country to another. Understanding global markets is essential for navigating today's interconnected financial landscape. Next, let's look at the role of financial intermediaries. Financial intermediaries are institutions that connect savers and borrowers, making the flow of funds more efficient. Examples include banks, mutual funds, and insurance companies. By pooling resources and spreading risks, intermediaries help channel savings into investments and support economic growth. They also provide valuable services like payment processing and financial advice. Now, let's discuss the importance of liquidity in financial markets. Liquidity refers to how easily an asset can be bought or sold without affecting its price. Highly liquid markets like major stock exchanges allow investors to enter and exit positions quickly. Liquidity is essential for market stability and investor confidence. Financial institutions play a key role in providing liquidity by acting as market makers and facilitating trades. Next, let's explore the concept of risk and return in finance. Finance, risk, and return are closely linked. Higher returns usually come with higher risks, while safer investments tend to offer lower returns. Investors must balance their desire for profit with their ability to tolerate risk. Financial markets and institutions provide tools and strategies to manage risk, such as diversification and hedging. Understanding risk and return helps investors make informed decisions. Now, let's discuss the importance of information in financial markets. Access to accurate and timely information is critical for the proper functioning of financial markets. Transparency ensures that all participants can make informed decisions, reducing the risk of fraud and market manipulation. Regulatory bodies require companies to disclose financial information to maintain market integrity. The flow of information helps prices reflect true value. Next, let's look at the role of credit ratings in finance. Credit rating agencies assess the creditworthiness of borrowers, such as companies and governments. These ratings help investors evaluate the risk of lending money or buying bonds. A high credit rating indicates a low risk of default, while a low rating signals higher risk. Credit ratings play a crucial role in the functioning of debt markets and influence borrowing costs. Now, let's discuss the impact of interest rates on financial markets. Interest rates are the cost of borrowing money, set by central banks and influenced by market forces. They affect everything from mortgage payments to business loans and investment returns. When interest rates rise, borrowing becomes more expensive, which can slow economic activity. Conversely, lower rates encourage borrowing and spending. Understanding interest rates is key to navigating financial markets. Next, let's explore the concept of financial innovation. Financial innovation refers to the creation of new financial products, services, or processes. Examples include electronic trading platforms, exchange-traded funds ETFs, and mobile payment apps. Innovation can make finance more efficient and accessible, but it also introduces new risks and challenges. Staying informed about financial innovation helps investors and institutions adapt to a changing landscape. Now, let's discuss the importance of ethics in finance. Ethics are the moral principles that guide behavior in financial markets and institutions. Ethical conduct builds trust, protects investors, and ensures fair treatment for all participants. Unethical practices such as insider trading or fraud can damage reputations and destabilize markets. Financial professionals are expected to adhere to high ethical standards. Next, let's look at the role of financial education in empowering individuals. Financial education equips individuals with the knowledge and skills to make informed decisions about saving, investing, and managing debt. Understanding how financial markets and institutions work can help people achieve their financial goals and avoid common pitfalls. Education also promotes responsible participation in the financial system. Now, let's summarize the key takeaways from our exploration of financial markets and institutions. We've covered the essentials of financial markets and institutions, from the different types of markets to the roles of various financial institutions. We've seen how regulation, technology, and ethics shape the financial landscape. Understanding these concepts is crucial for anyone looking to navigate the world of finance, whether for personal or professional reasons. Remember, finance is not just about numbers, it's about connecting people, ideas, and opportunity. Thanks for joining us on this journey, and keep exploring the world of finance.